Alright, how's it going, everybody? My name is Kustrom. I'll be teaching you today. Today we are going to be discussing the concept of the EMA, or just the moving average in general. So what does the E, since I gave away the MA, what does the E stand for? It stands for exponential moving average. So I'm just going to be giving a summary of the difference between an exponential and a regular moving average, and then jump into how we use them. So an exponential moving average, just like a moving average, takes in the sum of values that the price was at over a period of time, a look back period. So say, for example, the 9 moving average. It looks back 9 candlesticks. It averages the closing price of each of those candlesticks. And then, so it adds them up, divides them by 9, the number of candlesticks being counted. And then it forms a value at the end of it. And that is effectively your ongoing trailing moving average, right? Now, how is an EMA different? Very, very simple. It's just a slight modification to the calculation, right? So the EMA adds more weight to candlesticks that recently occurred than candlesticks that occurred longer ago, meaning that the candlestick that just closed before the current one that is still being printed has more weight to it and has a bigger what's it called, number assigned to it. Dude, how am I forgetting the fucking term for that? Oh my god. Stay in school, guys. Stay in school. It's not cofactor. Whatever, dude. So it has a bigger multiple on it, while the 9th candlestick in the look back period has a smaller weight to it, probably less than 1, to make it worth less. So that is the only difference between an EMA and a regular moving average. It's that it takes into account the more recent candlesticks to a higher degree. So why do I use EMAs rather than moving averages? Just because I think we are in a very volatile market, relatively speaking. Things occur very quickly. The moving average, therefore, and especially with the type of trading I do and what I use the moving averages for, I want it to reflect recent price action as best as possible, because really what I use the moving average for is a verification of trend. Okay, and we'll just jump straight into that. So how do I use moving averages? There's a lot of different YouTube videos out there giving different strategies and everything. I like to keep, as with everything, pretty fucking simple, right? This is mostly a game of patience, intuition, and then your homework. So the strategy and execution, as long as you keep it really simple and consistent and according to some rules and principles, then you're gonna be good in this, right? So I don't really take a lot of the execution into that high regard, because 99% of the execution is just not making mistakes that you can easily avoid because you know they're wrong. So with EMAs, I look at them not in a like, oh, the EMAs are crossing over, which means, you know, like one goes below the other. Oh, look at the EMA, it's super overextended, you know, like these things do apply, of course, sure, but really what the EMA should serve as is a confirmation of trend. Now, how do you do that? Well, it's pretty simple. Just think about it in theory, right? So if price is significantly above the moving averages, then that means that price is above the average that it has been over the last period of time, whatever the EMA look back period is, right? And if it's an EMA specifically, then it's even higher than the much higher than the real average, and much higher than the real average, and still higher than the EMA average, because again, think about it, the EMA is taking into account into a lot higher weight the recent candlesticks than the prior ones. So the candlestick that is currently here, for example, is so much higher than the EMAs, then this reflects that the price is just moving incredibly fast compared to the last couple of candlesticks over here. And obviously you look at the chart and it's just very clear, right? So when price is above the moving averages, we are bullish. When price is below the moving averages, we are bearish. Very, very simple idea. To take it a step further, when price is above the moving average, we want to see some specific behavior. So we want to see the EMA turn from not just a confirmation of the average of the price over a period of time, but also into support or resistance, right? And these are not static support and resistances, like say the trend lines, where they, if you do your trend line correct, you're not going to want to change it. No, these are active. Okay, so they're dynamic. They move along with the price, right? So because of that, EMA should really be not viewed as like, oh well, okay, if it comes down, for example, right? So Bitcoin's rising over here, you're waiting for a pullback. Okay, I always say just wait for it to tap the EMAs or for a pullback in earnest, right? So at this point over here, you're seeing all the chop. This is on the daily time frame. It's really holding up well. So it's hard to call a pullback in significant degree, but I can see the moving averages coming in. So I wait for the touch on that to go long, right? Because of that, then I can't simply say like, oh, I'm gonna set an order right here. The EMA didn't even touch it right here, so we're not even sure. You need to have your order go in line with the EMA and actually buy like right on it or around it when it touches. The touch is super important. Okay, it can't just be like, oh, okay, this is my trend line, I'm gonna set an order right here. You need to actively like put an alert on the EMA, and then once you get alerted that price is there, then you can go look at it and make a trade based off that. But you can't just do one and done like with a static support and resistance level. Now, moving on beyond that, like I said, if we're above the EMAs, we're bullish, below, we're bearish, right? And then when we're going sideways on them, like over here, for example, or over here, this is chop and consolidation. Makes a lot of sense, right? What you're looking for when you want to see EMAs act as dynamic support and resistance is when we're above. Okay, the uptrend really gets confirmed when we are above and when we retest the EMAs. Okay, now keep in mind that sounds similar, right? It is similar because it's the exact same conditions that we use to confirm a breakout, right? A breakout is only confirmed when it breaks out of the support and resistance level and then does a retest of the SR level. And then once the retest is confirmed and it continues in the direction of the breakout, that's when it's safe to go long or short, right? Likewise with the EMAs, we do not consider this uptrend completely safe until it retaps the EMAs and then shows me a further impulse up, right? So at any point over here, it could have touched the EMA, got rejected, and then came back down, but it did not. And that gave huge confirmation of this trend continuing up. And then as you can see, the trend was pretty much confirmed to be going higher every single time. We never closed below the EMAs over here. And then finally, until we started consolidating, did we close above the EMAs. Now, another thing to mention is that the EMAs apply to each respective time frame. Now that is very obvious, but it has some big implications. It means that the daily EMA values are not going to be the same as the weekly, are not going to be the same as the hourly, the 4 hour, the 5 minute, the 15 minute, etc., etc. But again, just like with all the rules in TA and trading, trend lines, EMAs, etc., the principles that you learned for them are not bound to any specific time frame. So if you see price breaking out above an EMA like this and then doing the retest of it over here, then that counts as much on the 5 minute as it does on the hourly, as it does on the 4 hour, the fucking 2 week, the 3.5 day, whatever time frame you want to come up with, right? The principles stay the same. So you have continuation, basically, is what you want to be seeing with an EMA. It tells you whether the uptrend or downtrend is continuing or not. And if you look carefully, you can see often in sustained trends that the EMAs, specifically if it's sustained, think about it, you want to look out on the weekly time frame. And by the way, I'm going to be making a video discussing all of time frame analysis, what time frames to use, what weights you should be putting on them, like of importance, all that stuff. So don't be alarmed if you don't understand what I'm talking about over here. But so if I'm seeing Bitcoin break out on the weekly and then hold these EMAs now, like very consistently, you see it's 1, 2, 3, 4, 5, 6 weeks, and then right here again, 1, 2, 3, 4, 5, 6 weeks again, then this is a really big sign, right, of high long time frame expansion, right? A long time frame uptrend, which we got. Now look over here. This trend was pretty much remained intact the whole time as long as we stayed above the EMAs. But as soon as we started losing it, guys, in the next preceding weeks, this was marked the top, and then we dumped pretty massively. Then we came back in over here, and again the uptrend was then confirmed yet again because we broke down, consolidated below the EMAs, broke out above, retested with a close right at the EMAs, and then went even higher. But then look, once again, we lost the EMAs. It came back in for the retest, just like with the SR level. It came back in for the retest. It is failing on 4 weeks of price action, and then it came back down. Tried, failed, came back down. Now you can see the opposite. The EMA is now acting, instead of support, it's resistance. Resistance, resistance, resistance here. Finally, reversed it, consolidated here for a long time. Broke out, now it's support. Support. Chopped around here, broke out again. Support, support, chop, breakout, right? So, and a trend and its duration. Okay, so that was effectively understanding how an EMA shows you the trend and how you can validate it using price action and its behavior at the moving averages. Now, how long can you expect a trend to last, right? Like, let's say Bitcoin is moving over here and you're like, holy fuck, I think we're gonna make a run for all-time highs and go higher, but I just don't know exactly how. Well, sorry to burst your bubble, but I can't really give you like an exact figure. Anyone giving an exact figure of like, this is going to be the market cycle top or something is talking out their ass, or just does not have anything that is completely verifiable. But one thing that I can tell you is, for example, that if I see price breaking above the EMAs on the weekly time frame, then I'm going to be pretty sure that this rally is going to be sustained for several weeks. Usually, and there's actually, this is where it's nice, a very, very pretty consistent amount of time. It is 30 to 60 candles. Okay? So whatever time frame that you see a breakout occur in, whenever you see a trend set up, really we can start it from over here because this high volume sell off, and then from then on that marked the bottom. So from here all the way up until the top area ish, There's a usual belief, and this has actually been studied. I gotta find the exact like paper showing it. But statistically, when you have trends form like that and pattern breakouts, it's said that you want it to wait 30 to 60 days or units of time in the candlestick for that pattern to play out. So if we do something like, oops, like this, from here till here, that's about 52 bars, so 52 candlesticks. So that's about right. I'd say like maybe if we went literally over here before the breakdown really occurred, that's exactly 60. So you tend to find that things take about 30 to 60 candlesticks on any time frame. Okay, so if I'm observing this weekly breakout above the EMAs and I'm expecting now a long-term weekly uptrend, then I should be at bare minimum expecting it to last 30 candles, maybe towards 60, sometimes a little even more. That this is generally a good range, and I should not be, for example, getting out after week 2 because I think, dude, it's so fucking overvalued now, it moved so much. Like, stop, take a second, look around. You're looking at reclaiming of the weekly EMAs. Look at every time it's done that, right? Look at over here, several weeks. Over here, several weeks. Over here, several weeks, right? That's why the moving averages are a big event. If you start, paying attention to more like financial Twitter and the financial community and everything, they will constantly, when the stock taps its moving average, it goes below it, they're like, holy shit, this is generational. Nvidia touched its 8-day MA, or Nvidia touched its 200 SMA, right? All that stuff, basically. Why does it get so much like attention? It's because the moving averages play a huge role. Price's position relative to the moving averages, especially on the big time frames, will reveal where the trend will be for a long time. All right, so you really want to understand how price's movement in respect to the moving averages, and again, that famous SR flip above or below the moving averages comes into play and allows you to make a lot of plays. Now, with that being said, I'm going to conclude the video here. There are a couple more things that I'd like to discuss on trend lines, that being like, for example, what type of trend lines to use, the importance of them, like 200, etc. Or sorry, not trend lines, moving averages. But nonetheless, I'm going to save that for a separate video. This and all the educational videos that are going to be coming out first are all introductory and not meant to fucking dunk your head into the water, but let you dip a toe in at first, So as you feel more comfortable, we are going to be expanding the difficulty level and the expertise level. So with that being said, thank you very much for watching. Have a great rest of your day.